Alright, legends, this is going to be a quick tutorial on the 2022 model. And I know I earlier said that IFVGs are the easiest model out there, but trust me, this one is even easier than IFVGs, and that's the reason why this is the most commonly used ICT model out there. Trading it is very, very simple, but not so easy. So let us see how we trade this model. So the sequence is such: price displaces in any direction, creates a fair value gap, and then moves away from the fair value gap, comes back, taps the fair value gap, and then continues in the direction of the displacement, right? So fair value gap here, bullish displacement, one bearish candle. You can think of it as an order block, but let's not talk about that right now. Next candle comes back, touches this, and then goes. Similarly, bullish displacement, order block, come back here, and then continue. Now, all four of these are perfect examples. Why do I say that? Because each time price comes back, it respects the center point, the consequent encroachment, the 50% of that gap, right? So, bearish gap, it comes back to 50%. As long as the bodies are under 50%, it's fine. And for this, for a bullish example, as long as price is above the 50%, that means the bodies are above 50%. The wicks can go all the way down. They can trade to and through the gap. It's just that price should not close. So these are some perfect examples. Here you can see again, it is perfectly respecting the 50% level. So the 2022 model also has a lot of imperfect examples, right? So this bullish displacement right here, price closed almost at 75%, went back, came back, touch it again. So there's no rhyme or reason to this, right? Except for the fact that it is still being respected. This example, price closed almost at the bottom of this gap. This wick took out this low. So you can imagine what kind of a move that might have been. But it was still bullish. That means it held this and then displaced instantly, right? Similarly for the bearish gaps, price comes back, trades multiple times within it, to it and through it, and still continues respecting it. All right, so where will price go to? So there's only two categories where price can go to, and those are either one, order-based liquidity, and second, inefficiency-based liquidity. So order-based liquidity means liquidity that is around a certain price point, right? So let's say, for example, day highs and lows, equal highs and lows, session highs and lows, and these are essentially the same thing, right? So for example, a day high could be session high also. Asian session low could also be a daily low, right? So it is the most obvious high or low on the chart. It doesn't have to follow any of these definitions whatsoever. And inefficiency based liquidity, that means PD array based liquidity. What is PD array? PD array means price delivery array. Price forms that and then uses that as a reference point for further movement, right? So for value gaps, it comes back, touches the fair value gap, and then moves on. So that shows, for example, in this perfect example, it comes back here to this PD array, references this, the 50% of this, uses that as a springboard, and then continues above. So let's see a few examples of this and how you can combine both of those liquidities to determine your drawn liquidity to see where price is moving towards next. So this is the weekly chart. The highs and lows of this candle are marked. So price, weekly chart, daily chart, right? So price comes down, takes this low first, creates a fair value gap, pushes above, right? So take out one low and then go towards the opposite side. Similarly, you can see here, when it touched this point, actually even before that, this large fair value gap, you can see price is being drawn towards this, right? Towards the fair value gap, and here you don't know exactly what's going on. So the draw is not clear. But the next day comes around, and then you have this huge candle taking out the low. So that means we are currently bullish. Inside this, there are multiple bullish fair value gaps. As you can see, this one right here, it was tapped right here. Continue, this fair value gap right here, tapped here, here, and here. Again, another fair value gap, multiple taps, and continuation, right? So think of it this way. There's order-based liquidity here and here. Why? Because anyone going long or short here are going to be placing their orders at the lows or at the highs. Long-term holders are going to place their stop losses at the lows or the highs. So you see, every time price comes here, there's such a aggressive reaction. Right here, look at this bullish fair value gap just running through that liquidity. Right? So a few weeks ago, we had that huge drop, and when the Trump tariffs announcement came around, price dumped, absolutely dumped. So what are the probabilities that it is going to stop at a certain level? No one knows, right? There's so many fair value gaps here that were left open, but we chose this one. So you never know which one we are going to draw to, and if you don't know which one we are going to draw to, just zoom out, take a look at the bigger, higher time frame. Right. So this is the 4-hour chart. If you zoom in to a 1-hour chart, again, you can see, take out this high, come back all the way to this fair value gap to continue higher. And as of right now, price has traded above these highs. So you can see what kind of a recovery that was. So best liquidity targets are going to be equal highs and lows. Equal highs and lows meaning they are placed within 5 to 10 points in NQ, and then about 5 to 10 ticks for every other instrument. And inefficiency based, fair value gaps and opening gaps. Opening gaps, new day opening gaps, and new week opening gaps. So what you want to understand is that when we execute on the 2022 model, let's say price comes back here, you are bullish, you take a buy. So where do you target? The best target is going to be the nearest high, or if there was a bearish fair value gap right here. For example, let's see here, right? Price comes back, you're bearish, you take a short. What is the best target? The lowest hanging fruit is going to be this low, because after that, price is choppy, right? Similarly, price went down, touched this. What is the best target? Opposing pool of liquidity, this. Or if you zoom out, there's probably more targets here, but for now, that's all you need to understand, that when price leaves a fair value gap, no matter on what time frame it is going to go towards the liquidity of that time frame. And you need to zoom out and be better at understanding where price is coming from and where it is going to. Hopefully that was helpful, and like always, peace to the Middle East, baby.